When you zoom out and examine how traditional markets behave, the idea of organic price discovery starts to look far less romantic. In equities, commodities, and foreign exchange, prices are not magically found through random participation. They are negotiated, hedged, structured, and reinforced through layers of financial instruments long before the public interacts with them. The crypto market is not immune to this reality. In fact, as it matures, it is increasingly starting to resemble the same framework. A growing number of analysts have pointed out that Bitcoin itself appears to be experiencing diminishing returns with each cycle. The upside becomes smaller, the time frames stretch longer, and volatility compresses. It almost feels like Bitcoin has become a pressure valve for retail enthusiasm, absorbing attention and speculation while more specialized assets quietly develop behind the scenes. This doesn't diminish Bitcoin's role, but it does reframe it. The spotlight often shines where institutions want it to shine. And this is where the conversation moves from what will the price be to something far more unsettling. What if the price has already been set? The theory surrounding XRP suggests that its value may not be discovered through open market chaos at all. Instead, it may have been predetermined through private negotiations years ago, long before most retail participants ever paid attention. The argument is not that there is a single document spelling this out, but that this is exactly how large-scale finance operates. Initial public offerings are not priced through apps or social sentiment. They are priced in boardrooms. The public market is simply where liquidity is distributed, where disbelief plays out, and where volatility masks the underlying agreement until systems are ready to activate. When you look at commodities like gold, oil, or wheat, their prices are not decided at the gas pump or the grocery store. They are set in derivatives markets. Futures, options, and swaps establish expectations. Those expectations shape behavior. Behavior then reinforces price. This is critical because institutions moving trillions of dollars cannot rely on the randomness of spot markets. They require stability, predictability, and permissioned structures that allow them to hedge risk with certainty. This leads to one of the most misunderstood ideas in crypto. Assets like XRP are not designed to function primarily as speculative investments. They are instruments. Instruments do not move based on hype. They activate based on mathematical necessity. For global payments to work at scale, you cannot have double-digit percentage swings triggered by tweets or headlines. You need a reliable fiat reference point that allows value to move instantly without slippage. Banks don't hedge on hope. They hedge on certainty. If XRP is meant to function as a bridge asset, it does not require retail approval to fulfill that role. It requires system-level readiness. When the plumbing is complete and the derivatives markets are mature enough to anchor expectations, price does not climb step by step. It simply snaps into place at a level that makes the math work. We are watching the architecture of a new financial system being assembled in real time. Most people are distracted by short-term price action, debating support and resistance levels that may ultimately prove irrelevant. Meanwhile, the real signal is buried beneath layers of infrastructure, regulation, and institutional alignment that rarely make headlines. This brings us to the mechanics of how a price can be effectively set without a single announcement. In modern finance, the spot price you see on exchanges is not the driver. It's the reflection. The real influence lives in derivatives markets. Futures, options, and swaps now represent the majority of trading volume across the crypto market. When those markets reach sufficient depth, they don't follow price, they dictate it. If major liquidity providers agree on a valuation within the derivatives complex, arbitrage and hedging naturally pull the spot price toward that level. It's not a peg, it's a consensus anchor. And when you pair that with regulatory shifts designed to remove friction from everyday digital asset usage, the direction becomes hard to ignore. None of this is about excitement or speculation. It's about preparation. And as always, this is not financial advice. It's an observation of structure, incentives, and historical precedent. If you're finding value in this breakdown, make sure you're subscribed, notifications are on, and you've left a like. There's much more to uncover as we continue pulling this thread. To see how this structure is forming, you have to pay attention to recent legislative moves and how precisely they line up with institutional needs. Bipartisan efforts in the United States to exempt certain low-value digital asset transactions from capital gains taxes are not random. They are targeted. These rules focus specifically on regulated payment stablecoins and digital assets designed for everyday settlement. That distinction matters. You cannot run a global payment rail where every 3-second transaction triggers a taxable event for the intermediary. It would be unworkable. By smoothing out the tax code, lawmakers are effectively clearing the path for mass transactional velocity. This isn't about someone buying a $5 coffee with crypto. It's about allowing trillions of dollars to move across blockchain rails without getting tangled in outdated tax frameworks built for a completely different era. Infrastructure always gets built quietly, long before the public understands what it's for. Now, look at the pre-IPO theory through a more clinical lens. If you were a central bank or a major financial institution, would you ever rely on retail sentiment to determine the value of an asset critical to global settlement? Of course not. You would require negotiated certainty. You would demand to know the valuation before committing balance sheet exposure. This is how traditional finance manages risk, and there's no reason to believe crypto infrastructure would be treated differently. The theory suggests that price discovery for XRP didn't happen on exchanges during retail hype cycles. It happened years earlier in institutional settings where liquidity requirements, systemic risk, and global settlement volumes were modeled in advance. If an asset is expected to handle massive cross-border value, the math simply doesn't work at low valuations. Deep concentrated liquidity is required to move large sums without causing slippage or destabilizing markets. This is where the distinction between investment and activation becomes undeniable. Instruments designed for settlement don't appreciate because people are excited. They adjust because the system requires them to operate within specific parameters. As the crypto market matures, this logic becomes increasingly difficult to ignore. We also need to talk about standards. The global financial system is undergoing a massive software update through new messaging and data frameworks. This transition allows richer data to move alongside value, creating efficiency that simply wasn't possible before. Assets built specifically for this environment suddenly make a lot more sense when viewed through that lens. If the world's banks are moving toward unified standards, they need unified bridges. You don't build those bridges out of fragile materials. You build them to carry weight repeatedly without failure. In this analogy, valuation is not about speculation. It's about structural integrity. The set price theory argues that a predetermined value provides the collateral foundation needed for global settlement at scale. Notice how quiet many major players have been. Ripple's long regulatory battle wasn't just about legal clarity. It was about classification. Certain regulatory statuses unlock entirely different capabilities within the financial system. When regulators began shifting toward integrating blockchain into existing market structures, it wasn't a retreat, it was alignment. At the same time, derivatives markets have exploded in size. They now represent the majority of crypto trading volume. This is not noise. This is institutional ballast being loaded onto the ship. Volatility driven by retail speculation begins to fade when larger forces prioritize stability over excitement. What we're seeing now may be the final phase of an inefficient market structure. As this transition continues, the narrative changes. Instead of asking whether an asset will go up, the real question becomes when the system is ready to use it for its intended purpose. At that point, price doesn't need a catalyst. Utility becomes the catalyst. We're approaching what many describe as a snap-to-grid moment, a point where liquidity is activated and valuation adjusts to meet functional requirements, not because of headlines, not because of hype, but because the math demands it. And when that happens, the market environment we see today will look like a brief, chaotic prelude. Stay focused, stay curious, and keep questioning the surface-level narratives. There is still more to unpack as we move closer to the final trigger. The final trigger is not a headline, a press release, or a viral moment on social media. It's utility going live at scale. In financial terms, this is known as the activation of the bridge. Once the systems that have been quietly built in the background begin operating together, everything changes very quickly, and usually without warning. Think about what it actually means when global financial standards become unified. When every major institution is speaking the same data language, the need for a universal translator becomes unavoidable. Value has to move as fast as information. That's the entire goal. At that point, assets like XRP stop being speculative entries on an exchange interface and start functioning as liquid fuel inside the machinery of global finance. For a bridge asset to work, it must carry the load. If an institution needs to move $1 billion in seconds, the liquidity supporting that transaction must already exist. If it doesn't, the market breaks. Slippage occurs. Prices spike violently. The transaction fails. That is unacceptable at an institutional level. This is why valuation becomes a requirement, not a reward. To settle the trillions of dollars that move through correspondent banking systems every single day, the bridge asset must have enough value to absorb that volume smoothly. This is where the set price theory becomes less abstract and more mechanical. The price doesn't adjust because people are excited. It adjusts because the system cannot function otherwise. What makes this transition so striking is how quiet it has been. While much of retail attention has been focused on recent volatility, market flushes, and short-term narratives, the institutional groundwork has been completed. Regulatory disputes have been resolved. Policy direction has shifted toward integration rather than opposition. Derivatives markets have grown to multiples of spot market volume, providing the stability required for large-scale operations. This is the ballast. This is how you prevent a system from tipping when liquidity is introduced. When the switch is flipped, the goal is not explosive price discovery followed by collapse. The goal is equilibrium, assigned value, a level that allows the system to operate efficiently and consistently. Imagine waking up one day to a market that no longer behaves the way it used to. Volatility compresses. Price action becomes muted but decisive. The chaos that once dominated the charts suddenly feels irrelevant. At that point, the narrative changes permanently. What we currently view as wild speculation becomes a historical footnote. We are moving toward a financial environment where value moves seamlessly across borders, protocols, and institutions. The infrastructure is largely in place. The rails are laid. What remains is the final alignment between utility, liquidity, and valuation. This is why focusing solely on daily candles can be misleading. Short-term noise obscures long-term structure. The real shift happens beneath the surface, where incentives, regulation, and mathematics intersect. That's where the blueprint is being followed. On Lion of Crypto, the goal has always been to look beyond surface narratives and understand how systems actually evolve. This isn't about predicting a moment or assigning dates. It's about recognizing when a market is transitioning from speculation to function. The window for retail to position themselves ahead of fully activated infrastructure tends to close quietly. By the time certainty becomes obvious, opportunity has already transformed. This is not about chasing price. It's about understanding why price eventually stops behaving the way it always has. The store is opening. The systems are aligning. And the final piece is valuation that supports global utility. Ignore the noise. Watch the structure. The transition isn't approaching. It's already underway.